Hey, good morning, everybody. We're getting closer to the end of the week. A little bit of Captain Obvious for you, bright and early in the morning. Seeing a lot of people running their mouth about how they knew NVIDIA was going to beat it. If you run across one of these swelled head people, ask them what their trade was since they knew it was going to beat. I always love to hear the answer to that. You never know what's going to happen for earnings. So the market liked it. The forward outlook was pie in the sky, numbers that are unheard of, never seen before. But why not, right? When you're a mythical unicorn, you can pretty much just say whatever you want to say. The moat continues to be really wide. It seems like chips in general are doing really good this morning. So, unlike having competition between the peers, what's good for one is good for all. Little Three Musketeer thingy. Run it till it breaks, baby. So green on the screen, risk on around the world. Japan didn't really care, and Hong Kong, since theirs is supposed to be better, smaller, faster, little soft on that front, but really not in some kind of retaliatory way, or it doesn't seem to be taking market share away. They're just a little weak. All right, so that's really not a bad start. We're going to get some jobs data today, but it's really old data. I mean, it's always old, right? Because the economic data that we get is as laggy as an indicator. So, it's always looking back, but we're going to go all the way back to September for these job numbers because it's been a while. Yeah. We've already had the Fed meeting in between that time. And so, suppose the numbers are really bad. What are they going to say? So what? We already cut. And if the numbers are really good, they're going to say, see, that's why we shouldn't cut next week or whenever the next cut is. So, these job numbers shouldn't provide any shenanigans. I know we all need some shenanigans, but probably won't get it here. So we're looking at the December 10. Yeah, no, that's definitely not next week. Oh, what do we got? 3 weeks? Tres más. All right. So December 10, by that point, we'll have more clarity, more insight. There'll be a lot more talk about the Santa rally, which is still way too early at that point. We'll have a better idea of the window dressing and any sort of performance chasing that we might see towards the end of the year. But all of it, it's just really too early for that, right? As it stands at the moment, we are at a 30% chance of a rate cut. And we still have, nothing changed on the Fed side of things. We don't have the forward guidance. We're not on autopilot or anything like that. And like we've been talking about lately, when it comes to running a longer term portfolio, life is a whole lot easier when we're on autopilot. When you've got the Fed making snap decisions based on every single meeting and the data we get in between those meetings, it makes running a longer term portfolio a much more dangerous proposition, which is really the benefit of having ETFs and mutual funds, right? You don't have to be some technical analysis guru or market genius to figure out. You just stay long in the broader market and split it up between different asset classes and run it that way. It's not a stock picker's market in that scenario, right? You don't have to try to pick and choose winners and losers. Save that for when the Fed is on autopilot. Gerald Appel wrote a really good book about that. It's an old book, but so what? It's a really good book where he talked about being on the right side of the Fed and just using really simple metrics that any new trader could understand to be able to run a portfolio where you're not trying to be some market genius. If you haven't gotten that book from me at some point, then hit me up. I'll pass it along. I've got a PDF because I found the book online for free and you can read it and check it out. It is an old book, right? Like really old, but it's still a really good book. The number that got my attention that we could have some issues with today is look how wide the discrepancy is on those numbers. 22 to 50. Now, again, these are old numbers, so it doesn't matter. On one hand, it doesn't matter, but on the other hand, that's a really big number. So I don't know. Right? Even in Crash Derby, there's rules. So, they say, oh, it doesn't matter. It's a Crash Derby. Just smash the other person. But, oh, by the way, there's rules. So there's still things you can't do. These might be really old job numbers, but there's still rules to how we look at data and the expectations when it comes to how that data is going to present. So on the one hand, who cares it's September, but on the other, that's a really big discrepancy, and see if the market even notices. It's likely that the comments about the missing data is going to be more impactful than the data we're actually going to get today. Because I've heard that they're just flat out saying you're not going to get the other data. I don't know what the market's necessarily going to do about it. Not like you can have a sit-in. Hire some bond vigilantes. I heard Walmart was changing exchanges. They're going to keep the same symbol, but they are moving. That's kind of a really big deal this morning. I haven't had a chance to go through everything on the Walmart report, but it wasn't overly negative, or we would have felt it. Hard to believe, right, that Walmart has such impact, but oh boy, let them screw up and you'll feel that impact. We got the 10-year today. It says 2 o'clock. It's again one of those weird times. It's supposed to be 1 o'clock. We're not supposed to get 2 o'clock auctions, but I don't argue with what it says. The 4 week, it's really close up front. You just run the IRX to see that one. A lot of Fed speakers chipping their teeth. They're all just saying the same thing over and over again. You're not missing anything there. The only threat is any sort of gotcha statements or catch 22s being taken out of context. Foot and mouth, hoof disease. It happens. Uh, the thing is, it rarely happens. So people get complacent and then, they spring the trap, run a gotcha moment. Just be mindful when there's a Fed speaker running their mouth. Check to see if it's a recording or not. If they are meeting with like the Girl Scouts of America or something, at which point they probably won't say anything that has any impact. And if they're not taking questions, then there's no potential for the gotchas and being misquoted, taken out of context. We are going to get statements from the White House today. Not really expecting much. anything that can bring the rate cut back into play is going to be something to keep your eye on. And really, I would not dump your hedges yet if you're still running a hedge because of the Nvidia earnings and you were concerned that maybe it was going to be bad and it was going to hit your portfolio. I'd hang on to that just a little bit longer with that comment out of Japan for tonight. Sorry, I'm looking for something. Not finding it. I guess it doesn't matter. We'll just pick one. So this is getting a bit extended. You can see the previous level to contend with. It's likely that we're going to hit this and reject at least once, first time, right? It's like a first touch play. Even if we overshoot it, we've got, 111, 1236. By the way, that really nice inverse cup didn't play out, right? That kind of refutes the argument that I always make, but whatever. So this is the concern. And then we have comments tonight going into tomorrow. We're done with Nvidia, but Nvidia wasn't really the threat, right? Japan's the biggest threat on the board. So keep your eye on this. If you have it, you can also look at the JGB 10-year. Not really getting out of line at this point. Just watch it. 98.5. Nothing about that looks good, right? You see that rising wedge, classic textbook rising wedge. This isn't the right one, but I'm going to use it anyways. So rising wedges generally break to the downside. When they don't immediately break to the downside, instead they go up, it is usually a fake break fast fail situation. So we get this exaggerated hoorah to the upside and then dump back down. If you are trying to get projections on how far it should dump back down, generally we would want to measure the mouth or the widest part of the wedge and then project that in the other direction. So 1.5 and 2.0 is what we're looking for. %50 of this move Now that we've got all of that laid out, I'm going to just cheat it out here. There's 50%. Get the line to go. Ow, for goodness sakes. And there's 100%. Run it from the place that it breaks. So if this dallies for a while and then it breaks way up here, we would put the line way up there. At the moment, I'm just going to set it here because we could just reverse immediately. That would be 50% of the breaking point. This would be 100% of the breaking point. So wherever we break, measure that and mark out the 50% and the 100%. We haven't broke yet to the downside, so we don't know where that break is going to be. But 50% and 100%, that's where you do it. This is the other piece that's really out of control, right? So you can look at JP 10-year. You can run JP 10 the other way around. And then US dollar Japan. But that is the threat that we have. And it's a bigger threat than NVIDIA. The CTA charts that we've been focusing on, they are still downsizing their position. This isn't a flight to safety. They're not panic selling. They were very heavily allocated and they're reducing it. I would not read too much into that by itself, right? The enthusiasm was extreme and everybody piled in and gave it all it had. Now common sense and rationality is stepping back in and they're just getting rid of some of that risk. At this point, I'm not seeing anything too concerning. If it continues to leg down and there's no pullback, like you can see this pullback here, it's a little lift to the upside because that's what we want to see, right? We don't want to see just extreme drops with no pullback in the other direction. With gold, they're not even back up to this lower allocation, certainly not back up to the highs. A little bit of a turnaround, but we're not breaking this low yet. I wouldn't get too upset with gold. It's just in that kind of choppy digestion range, right? Copper, my China play, nothing. Wow, that's bright. Japan's spending package expected on Friday. The Japanese government is preparing an economic stimulus package exceeding 20 trillion yen, which is around $130 billion, to combat persistent inflation and rising cost of living. Japan has finally hopped on board and decided their only way to get out of debt is to spend like crazy and take on more debt. I don't know how you guys run your household, but that is not how I do it in my house. But whatever. They're they're not alone in this, right? That's the common way of nations around the world now. So they're just getting on board with everybody else. Yeah. Yeah. So let's see if the proposal, you know, rattles anybody's cages. It's not a surprise. They've done a really good job of telegraphing that this is what they're going to do. If they just popped up out of the blue with an announcement like this, then it would have caused a lot more chaos, but they've telegraphed it well. We've all seen it coming. They've had a lot of time to kind of digest what could happen. But the thing is, projections and hypotheticals don't cover reality. So once it actually starts going into effect, who knows what it's going to break. What is this going to do to the carry trade and margins and allocations around the world? Yet to be seen. I don't even know where to begin. But, just mark it down like the doomsday countdown clock. Herein lies day one. And we just go from there. They've got a GDP to debt ratio of around 240%. So we are back above the zero line. We're back above the 10-week. And at the moment, we're dancing on the 10-day. The 3-week is overhead, 67.61. And if we can get through the 3-week, then we have the 20-day above that because the 10 and the 20 are underneath. Yeah, last man standing sounds right. What's the musical chairs and whatever fool doesn't have a seat when the music stops. So we've had our bear surge when price crossed the 310 and then 3 crossed the 10 and both of those crossed the 20, which put us in a bear momentum with bear surge. But all of that has begun to flatten out. Price has crossed through the 3. It's working on the 10. If it gets above both of those, we're going to look for a 310 cross on the upside, be a bull surge. But then we need to get both the 3 and the 10 back above the 20 so that we can have bullish momentum in a bullish trend with bullish strength and a bullish surge. That's the way it would lay out. If at some point we fail today, we'll drop back down below the 50-day, and that's kind of going to be a big deal. So we still have the marker drawn from earlier this week. This midpoint, 67.50, is the midpoint of this measurement, right? So now that we are fighting at that line, we want to get above it and close above that today. But we also want to get above that 10-day, kind of a big deal. And then we'll work on the 20. When we get back up to this previous level up here, we're going to have some concern. This is a liquidity issue. We don't know if they're done yet. We don't know how much more is up here, and if we're going to be able to absorb all of that and get through it. But one thing at a time. First, we have to get there. We've got our new low. That's certainly not in dispute. Now that we've left it behind with the close yesterday and the drive up this morning, that puts this lower low almost in place as a surety. I know it seems like there's almost no way that we could say that it's not a lower low. But here's the thing. This is all we really have. This doesn't count yet, right? Because the day is not done. We could end up with a red day and a long wick that extends all the way up to this midpoint, and it could fall and close lower, way down here. If it did that, we wouldn't look at this low and say, oh yeah, look, that was a lower low, because we'd have the low here, right? So today needs to close higher than yesterday's close for us to look back and say that this 6,600 is actually our new lower low. I'm going to just ballpark it now and say it's going to be our new lower low, but it's really not confirmed until tomorrow. There's yesterday's halfback, 66.59, so basically 66.60. If we begin to fall back down, we've got yesterday's high, and then yesterday's close, and then yesterday's mid, then the open, then the low, and then this week's low, and then down we go, right? Level by level by level, like we always do. Just run it by levels. Otherwise, to the upside, we got to get through that liquidity that I pointed out. There's a midpoint up here that needs to be addressed. It'd be the midpoint of this really big bar. And that's 68.19 or 68.20. So maybe like an overshoot of this mess. And if we measure the whole thing, we get this midpoint right here, 67.75. So a lot of mids and a lot of moving averages and volatility triggers and zero gamma and double gamma levels and just all kinds of junk and trash over our head. We can do it, but it's going to take time, or we're going to need just this fire hose of fuel pushing us to the upside. And if you look at the way we've been hanging out all night, we don't have that drive. We had it right at the close, but through the Asian session, we really didn't do anything. We got into the European session, and we had the move in the kill zone, which, you know, it behaved like it usually does, and we pretty much just unwound that. Now we're running a zipper on each side of VWAP. We got nothing. Where's all that drive and enthusiasm and the bullish hunger? Overnight volume at 102,000. It does show that there was increased participation last night. So that's always good. They're not sitting out waiting on something. They're not adding any additional hedges this morning. So there is really no indication of concern for September's job numbers. Why would there be, right? This is November, and we should be looking at October's job numbers. So I don't think there's really any concern over what September's numbers were. We need to keep the inside day breakout. So for yesterday's high is our line in the sand, 67.11 cog line. We've already reached the ADR half. We've got an old phrase that says if we get there early enough in the day, we can go to the other side by the end of the day. Well, we got there pretty early. It doesn't show the line earlier than, say, 1 a.m., but it was there all night, right? Just Thinkorswim doesn't project it. So we hit it last night, right? Before 8 o'clock. How much earlier do you need to hit it? But we didn't dump down and just come to the other side. We fell away, and sure, we set that lower high, but we set the higher low here too. And now we broke that and we're making a run for it. So if we can challenge our own Globex high and we can get through this liquidity that's sitting up here, just absorb all that, get past it, then we're on a run to the upside again. We've got the full ADR up here. That is the base case target projection. And if we just keep on going past that yellow line, then we're going to be stuck in that scenario where we begin asking, when is this going to stop? One of the neat things about running these ADRs is when they start. So the SPX, which we don't have any charting for in the overnight, it will not get the ADR lines until 9:30. So if we continue to run and, for an example, the ES gets above the yellow line here before 9:30 and then the market opens, the SPX is going to get its lines at that point. So we could see a continuation higher until the SPX gets to its red line or yellow line, right? It's a nice little trick that works if we continue to go higher or lower than the ADRs on the ES. The trick is to bring up the SPX and see how far away that market is from the ADRs. And when it hits them, the ES stops, the NASDAQ stops, everything generally pauses there. So that'll be what I'll be looking for if we continue to push this morning. I don't know that we're going to get that continued push. Seems like it might be waking back up, right? If there wasn't much enthusiasm through Asia and Europe, as we begin to come online, maybe that's going to be the driver. My concern is what happens when Europe closes? Europe didn't get us here, so it's not like we're going to lose some bullish bias and fade away because we're seeing Europe close. But if Europe was holding us here after the pop and then Europe closes, there's nothing else holding us here. We could fade back down again. So keep your eye on Europe's close today. The thing we're going to be looking for is just a complete change in market behavior, market sentiment, the candles, pace of tape, the size of the queue. Want to see if that begins to shift after Europe closes. If we break this Globex low, Then we want to run to the Globex mid, which is going to be back inside of yesterday's range anyways. So we'll hit Friday's or yesterday's high before we'll hit the Globex mid. Oh, well, just barely. So I guess it doesn't matter either way. Let's run the 6 o'clock. We'll do it that way. Well, I guess we've already been dancing on that mid. So there's the mid to break. If we break the Globex mid, we challenge yesterday's high, and then our Globex low, and then yesterday's mid and RTH low, and then the full low. Level by level by level, we'll just run it all the way back down. The 1, 2, 3, 6 is off the table, right? We don't have a yesterday's 1, 2, 3, 6 because we blew right through all of that. But you could measure the Globex range and project that 111 and 1, 2, 3, 6. I would just be looking to get into the first 30 minutes of today and use that. If we can get above that weekly pivot, we will be bullish on the week and bullish in the broader context of the market. 6780-ish. It's a narrow channel, and a narrow weekly channel implies that if we break out on the weekly, we likely keep it and continue the breakout. But that's not what happened at this point. Of course, we could break the other direction, right? That would be getting above 6,800 and continuing to go higher than that into the end of the week. But to do that, we've got to get above the weekly pivot point, which is this line up here. So get above that, and then Monday's high, and then it's a run to the upside. Otherwise, today's floor pivot is higher than yesterday. That's bullish. Price opened above it, and that's also bullish. But it's a missed daily pivot. You can see we have not hit this pivot yet, but it doesn't count as a missed daily pivot until tomorrow. So right now we're watching it and saying, yeah, we haven't hit it yet. It's likely we will. We hit them most of the time, but we could make it all day without hitting it. We won't know until the end of the day. So tomorrow we would look back and say, look, that was a missed daily pivot. Just like we had back here, we did not hit this one, but it didn't count until the next day when we looked back and said, oh yeah, look, we didn't hit it. Since this is the low of the run, this is the one that counts, right? This was at the end of a run, so I guess it kind of counts because it's the capitulation low before the reversal. This one counts as a good one if we miss it, because it's the start of where we can get consecutive missed daily pivots on a run back up, right? You get 2, 3, 4 of those in a row. Crazy bullish to have that many back-to-back consecutive ones after a reversal on the lows. It's really nice. If you don't know what the heck I'm talking about, hit YouTube and just type in missed daily pivots. The guy that really developed all of this logic, he's got videos on YouTube. It's something that you can use as a swing trade strategy, day trade. I don't trade the strategy myself, but once you learn it, you can use it as a part of your analysis. So that's where I found value with it. One of the concerns is that since we've had these 2 narrow range days in a row, that's NR2, missed daily pivot, MDP. Yep. Because we had 2 narrow range days in a row, that has shrunk our S&R line ranges. And as you can see, we're now firmly above R1. If we're going to go down, we obviously need to break R1. At 67.32 cog line. Cog lines, generally speaking, are going to be a little more structured. So we could, generically call that support. If we break R1, S2 is on the table. That's all the way down here at 65.80. I know that doesn't sound good with, big old NVIDIA beat and everybody's bullish enthusiasm, but that's the way it lines up, right? If you break R1, you have S2. If we'd have gone the other way around and was sitting on S1, we'd be talking about R2. It is worth noting that the indicator is projecting bullish bias, right? How do we know that? The range between the pivot point and S1 is smaller than the range between the pivot point and R1. We can see the distance between this pivot point and R1 is much bigger than the pivot point and S1. So the indicator is saying, yeah, it's more likely that we go up from here than down from here. Just remember that this indicator isn't making price do anything, right? It's not going to make us break out. It won't hold us back from breaking out. It doesn't drive us to any line level or give us any flows or anything like that. It's just insight and perspective. So if we fail R1, we want to break this mid, challenge the channel on the daily pivot, get through the daily pivot, S1, yesterday's low, S2. Level by level, right? Just like we always do. If we get above our own Globex high, then we've got R2 and then the weekly pivot and the weekly pivot channel to deal with. There is an R3 way up there, but it's rare to get an R3 in the indices. You can get them on like equities. You get a good bullish move or bearish move on some headline and some Joe Schmo lawn mowing company and blow it out to an R4. But the ES, the NASDAQ, they don't often do an R3 and S3. Not to say that it can't, because it certainly can. Yeah, the thing about strategies, like that pivot point strategy and missed daily pivots, a lot of those I have no interest in trading at all, but they offer really great tips and tricks and consistent tools for analysis. So missed daily pivots is one that I found a long time ago, and I really like it. I don't trade it, but I really like it for analysis. There's another one that you can use that's the open range for a daily time frame and a weekly and a monthly, but I like it on the daily. Imagine that, right? A daily open range rather than like your 5-minute open, 30-minute open, 1 hour open. Yeah, I call it the door, right? Day one open range, DOOR. Doesn't work good for futures, though. I'll tell you that. It's definitely an equities thing. We are trying to build out that first distribution. We were talking about this distribution yesterday in the live stream, this area here. I say it's the first because, well, we started the week up here and we built that distribution before we came down here and built this one. So now we're back up here trying to fill this in more. The concern was that it would act as a bit of a resistance, the whole zone, and we wouldn't even be able to get into it. Well, we're in it, so that concern is off the table. But now we can get stuck in it, and we can just spend the rest of the week here, really, hanging out in that level. if we build it out, then we could potentially see the point of control move up and end the week up here somewhere around that 67.50 level. And remember, we're still running 50s. I'm not done with those. So this could be a bullish pop in a bear market for all we know, right? I don't think so, but it certainly could be. Got a lot of reasons to believe that it could be, honestly. There's still a lot going on under the surface that implies this is really just making lower highs and lower lows. When we are looking at reversals in trend, I like a full set, and a full set is two. It's two lower highs and two lower lows. Well, we don't have two yet of each one because this was a higher low, right? This got enough scribbles there. We could add a few more. This was a higher low from here. So that is not a lower low yet. This was our first lower low. So now we got one, and we've got one lower high. I want two of each. So if we run up and we set a new lower high, that'll be two lower highs. And on the way back down, we'll be watching to see if we get the second lower low. If we do, we've got a full set, and that is a trend to the downside. Of course, we'd also be underneath all of the major moving averages except the 200, and we would have the 10 underneath the 20 and fighting to cross underneath the 50. And I mean, that alone can be considered bearish trend just by the stack of the moving averages. But I'm not a big fan of just leaning on moving averages, right? Because they can get all tangled up like spaghetti and then they're just worthless trash. It's better to either use a combo of price and moving averages or just use price. And for that, I want a full set, and we don't have it yet. But if I got rid of all the moving averages and all the lines and I turned these candles into a line, this is very clearly demonstrating that pattern. So we need to break the cycle. And to do that, we got to get above 6,900. If we don't, it won't be a really bad thing until we get below 6,600. So if we run up and we stop somewhere around, say, 6,850, we could still just digest right in here for a while and stay above that 6,600, and we still wouldn't crash and burn in the broader market. So, don't count your chickens before they hatch. A lower high is not the end of it. We still need that lower low. We really don't have anything else out here that's going to help us out. We ran through all this junk to the left. It wasn't helpful at all. It didn't provide any real insight. And on the week, we're back inside this upper zone. So that's what I want to focus on. If we get back inside of this value area, which is basically getting underneath 67, then we're unwinding and we're just going to break it all down. So let's just keep it above 6,700. Yeah, that's an ugly mess. It's like coyote ugly right there. 10-day, 30-minute volume profile and TPO. They're almost in agreement, but they both look like poo. Nothing here. We're going to wipe out some more candles on the left with every new candle on the right. The focus is that we need to get rid of this price shelf way up here with this volume. But that is days away. Friday, Monday, Tuesday, Wednesday. Yeah, we'll get into it like Wednesday, Thursday. It's going to take a while to get there. During that time, we could sit in this zone and build it out. The problem is we're going to wipe some of those candles off the board in the next 2 days, and that might be enough to shift that thing either down or up. I'm leaning to the idea that if we break back down here in price and we get underneath that 6,700, that we'll build this area out and the point of control is going to come down with us. If we don't do that and we get above that point of control, then we're going to be looking to build this level out up here and add more work to it, at which point the point of control is going to move up. But we would already be there, right? So we got to get through this level, that 67.75 zone. Then it smooths out, gets shallow. It's easier to move through shallow areas. But that's a lot of trash over our head. And it is a lot of work that we're going to have to get through. Yeah, there's all kinds of things when it comes to the end of the year. Performance chasing, window dressing. They'll rotate out. And there's been a number of investors that missed the boat on this move. They had some guy on Bloomberg the other day that continues to pound the table for 3 years now that the market is overvalued and is at risk of going down. And he's been advising his clients for 3 years to stay light on the upside because it's such a bad idea because there's just so much risk. So what? Everybody in that he's managing funds for, they're in what, fixed income and really lightly allocated to the upside and missed the whole darn run. Come on, man. That, I guess you got to bring someone on like that just to get the alternate point of view. But what are those guys gonna do, right? How are they gonna rotate and allocate as we get into the end of the year? So we can see the CTAs are backing off a little bit. Otherwise, if you've been here through the whole thing, I've pointed out what we've got. That's what we've got. We got a VPOC from 6760, basically, back here on Monday. The one that we built out for Tuesday, we ran right through that thing. But we'll just take that line and we'll build it onto Wednesdays because Wednesday gave us a VPOC. So we've got this level to get through, 67.58. I would just round it and say 67.60, but whatever. I'm not to the tick either, so I could be off by, 2 or 3 ticks. It's not a game of perfect. I don't care to zoom in and do that. To the downside, we've got 66.54 ish. It's probably close enough. So we're trapped between two VPOCs. It's a lot of liquidity down here, and it's a lot of liquidity up here. In fact, if I zoom out just a little bit more, I don't even really need to zoom out. It's right there. That's the point of control from last Thursday, and then Friday, and then Monday. There's 3 points of control right here. It's going to be a significant level to get through, right? That's a big deal. So if we can get above it, and I don't mean just wick up there and, you know, wick up there. We need to get above it. I would just focus on like 6,800, get above that, get a close above it, and show that we want to keep it. Otherwise, these three levels of the point of control are a serious risk for today. And that's the point of these briefings, right? Is for today. You want to focus on anything else, ask me after the morning briefing. Weekly expected move. We are back inside the box. We're almost back to Friday's close. If we can get through that, we'll focus on Monday's high, and then we have the upper edge of the weekly expected move. I built a trade strategy years ago that talks about running these lines from one side to the other. And if we can get to one side early enough in the week, that's the play, is to run it to the other side. How early? Well, definitely Monday or Tuesday, take the other side. Early enough on Wednesday, if you're aggressive, take the other side. I don't generally trade the strategy when it's breaking the weekly expected move consistently week after week after week. Because when we're closing outside the box at the end of the week consistently, then it shows that we're breaking the system and that there's risk not being priced into the market, volatility is being incorrectly priced, and you don't want to run the strategy. But if we're closing inside the box in the standard deviation that it represents, meaning we're doing it like 70% of the time, then it's a good system to run. You don't have to put a lot of money at risk for this kind of a trade. You can just sell some put spreads down here, like short put verticals, and do them near the money or at the money, not that way out of the money 10 delta trash. I don't like that. Sell something in the 40s and 50s so that you actually get some meat out of that move and run it the other direction. Now, you could use that premium and buy some far out of the money calls, but then you're just compounding your risk. Same thing if we went the other way. If we had got to the top early enough in the week, you could run to the other side. These lines and levels, by the way, make perfect targets for butterflies, especially now that we can run butterflies 5 days a week. Like we talked about, we're at the 10-day, and with the imaginary little collar that I've got around it, we're still sitting inside of that half zone, half above, half below. This is not bearish to be at the 10. Think of a sports game where you start in the middle, right? Whether it's basketball and you're in the middle of the court, something like that. When you're dead in the middle of the court, you've got the ability to go to either side in a full run. But if you're already on one side of the court, then you've got nowhere to go except the other direction. So being at the 10 gives us a full 2.5% move in either direction that we could run before we start looking at being overbought or oversold or having moved too far too fast. It's a really good place to be. We did get those lower highs and lower lows that we had talked about, and we've turned things around. We don't want to get below this -2. That's going to start causing some issues if we get more than 2% below the 10-day. And looking at the 10-week, we're still not back there, right? We're just working our way down, and it's been that way since July. Just easing on back. This has not changed yet, and it's still one of the things I'm focused on to see change. We got to get above this one. That's a 4% move above the 10-week. That's a lot. Not expecting that to happen all in one shot either. But we got to turn things around at some point. We're almost back to the reset, and we'll see what we get. The main thing, though, is that we're not overbought. We're not overextended. We're not oversold. We haven't moved too far, too fast, and it does not owe us any sort of rebound or anything like that. Come on, Thinkorswim. You can do it. Looks like we may get a liquidity gap this morning. We were just talking about those yesterday. Remember, a liquidity gap is not an actual price gap. It is a gap in liquidity. Price moves so fast that it doesn't build any structure underneath it, and that means that we could fall right back down through it. The goal is to see it come back to where it started. Also, you want to break the candle down into quadrants: 25, 50, 75, 100. So when you do that, you want price to close in that upper 25%, or if it was a bearish candle, then you would want price to close in the lower 25%. We didn't do that. We closed a lot closer to the half. That really calls into question any sort of bullish bias. And then we're expecting the gap to get closed sometime between 10:30 and 11 o'clock. We also don't want any real wick on the opposite side of all of this. Well, we got wick down here. We closed too close to the 50. It's very likely that we're going to get stuck in this range and or just break out of this range to the downside and come on back in and get that gap closed almost immediately, which still doesn't line us out as bearish or bullish. Price wants to close that gap, and then we'll see. Keep your eye on reciprocation, right? Whatever we get above VWAP, we look for underneath VWAP, because that's what it does, right? It's generally speaking, that's how it works. So that's what we had above. That's what we would look for below. That's still above yesterday's high. So as long as we're holding above yesterday's high, everything that we've talked about today is still in play. And there's the weekly floor pivot that we got to keep our eye on if we're going to continue to drive up. But that weekly pivot is above R2, and we got to get above R2 to get to it. The VIX is down 15%. Of course, it was up 18%. No? Yeah, something like that. It was up quite a lot. So now it's down 15%. Over a 5-day period, that still means that it was up or is up one and a quarter over a 5-day period, even after giving back 15%. Nothing else is really down this morning except the Mag 7 down volume is down. And yes, that's a double negative. Work that out. Looking at what's up this morning, my benchmark being 0.5%. Oh, the dollar gold ratio is up. Miners, energy, China, UFOs. So we're getting that low float speculation moving around. Consumer discretionary, multiple styles of tech, communications, solar, uranium, quantum, robots. Oh, yeah, we got it all this morning. Lots of speculation plays. So we should start seeing more Bitcoin come in. And all of there's a little Bitcoin in there, a little, but we should see more. A lot of those miners should start coming back in, those Bitcoin miners, and those flywheel companies, the ones that are buying all these different kinds of coin hand over fist and just, bloating their holdings that way. I think we had a list of those. They're not in this, but still, I think I got a flywheel list somewhere. Mag 7 up volume is up. So we've got the sectors that we need for a rally day. The problem is if they rally too much in the pre-market, there may not be anything left when we get into the open, right? So that's a little bit to be concerned with. Depending on the broker that you use, Thinkorswim, you can go to Market Watch, choose the Visualize tab after 9:30, or just like right before 9:30, so you can get set up. Change from the heat map to the index watch, and then choose your index. Now you can make your own indexes, so you can make like a Mag 7 index. These are detachable, so you can stack them up, make them really small, so they don't have much of a footprint. This is advancing minus declining issues for whatever index you want. Take something like the NASDAQ 100. Now you've got the advance and decline for the NASDAQ 100 with volume and money flow. That's why I like it better than just using something like the ADSPD or one of those. So you can see once we get into the open, how many companies are going up, how many are going down, and where's the money flow going. If you have more advancing, but more money leaving than coming in, then you've got a divergence. Since we're using 100 names, whatever numbers you get, you can just use as percentage. So if 85 are going up and 15 are going down, then you can say 85% of the NASDAQ is going up, right? It's another really good benefit of using a 100 number. You can seriously just stack these up with as many indexes as you want. So S&P, NASDAQ, Dow, Russell, the Mag 7. That way you can monitor, do we have the breadth behind this move? We got the right sectors, certainly. We've seen that. But we want the real powerhouse names, the actual Mag 7 names, to do the heavy lifting. If you're limited on your brokers, and you say maybe you're using something like Webull or Robinhood or one of those, there's an ETF called Top T. That's a really good ETF to use. Don't trade it, right? We're talking about analysis, using it to evaluate stocks. It's the top 20 stocks, right? So it's a little broader than the Mag 7. It'd be like the Magnificent 20. Well, whatever. It works. So you could use that and match it with something like MAGS, MAGS. Those should show up on those brokers like Webull, Robinhood, so that you can at least keep track of what's going on, right? Because if you don't have the top 20 names in the indexes, you don't have the market. It won't matter what the other 480 are doing. You know what I mean? So just little tricks to get around whatever broker you might be using. All right, guys. So let's wrap this up, finish it off nice and easy. GTFO, like it always is. Got to get out of the box before we can do anything else. The Globex box. Run it all the way down. Still puts us inside of yesterday's range. That's what I was looking for. To get there, we're going to need to get through yesterday's high, then yesterday's mid and low, right? We got the ADR lines. We were already at one side. We're going to have to break down through those, but it's level by level by level. So The only concern that you have today at this point is to get the heck out of this Globex range. Nothing else matters outside of that, right? Because if you're still in this range, you got nothing. It's a 60-point range from 6,700 to 6,760. And it could be this choppy, nasty, violent mess. Maybe it will give you some really good price. Maybe. But I don't like running maybes. I like my money too much. So GTFO, get out of this box, and we run it from there. The midpoint of the Globex range was that level right there, right? That 25 area. It should be a good trading day now that the market has its biggest fear behind it. Just remember that the market's not looking at Japan, and that is the bigger one, right? The video was a concern, but not the biggest concern. Japan is, and that's going to be coming out tonight. So keep that in mind with the hedges that you're holding. Just make some money today. Be careful, be safe, watch the clock. I'll see y'all tomorrow.